IBS YouTube channel. If you want to be profitable in your trading journey, we are transparent on what we do here. Everything we do is based on what I trade. I don't hide anything from you. There is no special cost for anybody. There's no VIP. I don't do that. I give out all this for free. That is why some of you don't value my stuff here. This stuff is something that if you calm down to learn for months, just a month, you see that your trading system is going to change. Your history is going to change based on what you're following on this YouTube channel. Now, today I'll be talking about the candlestick analysis. Remember the last time we talked about the EMA, the 350, the 90, and the 10. Here we talked about how to use it to identify the trend. Remember, I said when the candles are above the EMA, you know that is a bullish trend. And when it's below, just like here, when it's below, that is a downtrend. Now, if you identify the trend of the market on the higher time frame, because this is a weekly time frame, if you identify it on the higher time frame, the next thing you have to do is understanding the candlesticks. Yeah, that is the most important thing. If you understand the candlesticks right there, I think you're gonna make a better decisions on your trading. Now, before I start, I want to mention something to you. I don't usually know the names of these candles. Like I usually say, it's not about you knowing the names of the candles. It's all about understanding how the candles move, the psychology behind these candles. And if you're making money from the market, there is no need for all these long keywords or grammars. You have to know that trading is all about making money. There is no need for you cracking your head trying to know the names of these stuffs. Just know how they react to the market, how they move with the market. That is what is very important. So I'll be saying two things involved in this candlestick analysis. First is for you to know retracement candle. Second is for you to know the entry candle. Now, when I mean by knowing the retracement candle, I always say that the market will not move in a linear direction without having a retracement. There is no way the market will move straight. There must be a pullback. Either the pullback is shallow or the pullback is deep. Either it's shallow or deep. So there is no way the market will just move straight upward. That is why some of you, when you enter a position and you see a retracement, you want to cut the trade short, which is very bad. Market is having a retracement. So far you have understand and identified that this market is on a moving or a downtrend, you have to know that there must be a pullback. So you don't need to exist your position. Like what happened here, maybe you took a trade at this zone and you see the market move all the way up there and you see this happening. Some of you will start trailing your stop loss upward there. I don't do that. What I usually do while trailing stop loss is just to move. If I took the position from this zone and move my stop loss just to protect this, and I don't move 1:1. Sometimes I don't move that, except I see that this has happened, retracement has happened, then I can move again upward again. That is when I begin to tell some of my students to trade your stop loss. But I don't usually do 1:1 because the market will always have a pullback, and if the market hits you and you have a break even for the whole of the week, it's a very bad trade. That is not a good trade. So you have to know that there must be a pullback. So retracement candles and entry candles are the two things you have to catch on this video today. That is what you have to know on these topics today. What I'm talking about, the entry candles and the retracement candles. Now, what are the entry candles? We have the ones they call the doji. The doji, the part of these retracement candles, and sometimes the bearish candles if the market is on a bullish run. Bearish candles, these are the retracement. Let me show you this on the screen. It's not about talking. I don't know the names of this stuff all the time. Now look at this. Now on the higher time frame of the weekly time frame, you have seen that the market has crossed above the EMA. Now the whole of this time you should be trading on the lower time frame. Your entries, when you see your entries on the lower time frame, your signals, you make an entry. But when this begins to happen right there, when you see these candles, this candle right there, that candle, that is when you should take a break of the market, or you trade with what the market is doing. But I advise you trade with the trend. But for me, sometimes I trade retracement. I trade retracement because I've understood the strategy. So when this is happening, the whole of this is happening, you stay off the market. When this begins to happen, you stay off the market. So these are retracement candles. All this stuff you're seeing here, they are retracement candles, like what you're seeing here, retracement candles. Now, that is what you should be doing, identifying the retracement candles when the market is on a bullish run or a bearish run. Now, what are the entry candles? The entry candles are these candles you're seeing here. These are entry candles. The hammer, the bullish, full bullish candle move, they are all entry candles. Like what you're seeing here, these are entry candles. Entries candles. This was a kind of a retracement candle because of the wicks, but it's still an entry candles if you look at the lower time frame. There was a trade I took here. So you can see that this here was like a retracement candle. When I saw it at the beginning of the week, that was when I took that trade right there. But the whole of this stuff was saying downtrend and trend. So sometimes we trade the retracement, but we don't stay long in the market. We just scalp a little bit and leave the market. Now let's go to other pairs so you see what I'm saying. Now you see the whole of this week was a buying candle. The whole of this week was a buying candle. But when this began to happen, all this was retracement candles. Retracement back to the EMA before we had a little bullish run and the market broke and started going downward. Now, when I see this, I haven't traded this market, this the volatility 25, because the week had a retracement candle right there. The week had a retracement candle. I haven't opened volatility 25 to trade. Now, if you go on to this, you see the market wasn't moving fine because the retracement was happening. So throughout the past week, the retracement has been happening right there. So I don't trade this week. I don't trade this week since I've seen this happening. So you have to identify that as well. Those are retracement candles right there. This as well. This as well, retracement that happened before the bullish run. You have to identify these bull candles. We have talked about that retracement candles and the entry candles. You need to identify those stuffs. Now let's go to the lower time frame for you to know the other parts of what you should be trading. Now, making an entry on the EMA 10, making an entry on the EMA 10, if you have identified the trend of the market on the higher time frame and the candles, if the candle that formed the week or the week before that, if the candle that formed is a retracement candles, you have to identify that on the higher time frame. Identify it all on the higher time frame before you head down to the lower time frame of either the 1 hour or the 15 minutes to trade. Now, if I would identify that, when I see a crossover like this with this kind of candle, so I love the hammer because they give me the confidence to take entries. When you see identify that, go down to this. I wouldn't make an entry with this candle. This is a doji. I wouldn't make an entry with that when I see the crossover. Now, that was something I said last time, that if I see how big this candle is, I wouldn't enter the market. I wouldn't enter the market because of the candles. The candle is too big. Because of my risk management, I wouldn't do that. I would just let the market sleep, or if I want to, I can make it a little bit easier when there is what we call the 50% entry, which is this. So if you divide this candle into two, 50% you can take your entry when the market has gotten to the zone. Take an entry to reduce your risk. That is what I do sometimes. That is what I do sometimes. But for newbies and those trading with smaller account, I wouldn't advise you to take entries with all these stuffs. These are not entry candles. You have to know. You have to know that these are not entry candles. You have to note it down there. Now, if you see this is an entry candle. This is crash 500 and entry candles as well. The entry candle, the hammer, this alone is the entry candle, not this other one. But the hammer there, the entry candle, one of the best. You can just decide that you will be using the hammer as an entry. You can be using the hammer as an entry for your trade. It helps a lot of times in these synthetic indices. I've come across it a lot of time. The hammer is one of the best for entry. That is why I don't play with it a lot of times. I don't play with it, and they usually reduce my risk. No, the size of the candles matters a lot. This right here, I wouldn't want to enter with this. This isn't it, but you can enter with this because this is a strong bullish move, and you can see that there was a weak formation right there, weak formation, and this formed, which identifies or signifies that the market is on a high bullish run. So those are the entry candles you need to note. Don't enter with this. If you see the inverted hammer happening above the EMA when you're looking for a buy candle, don't enter, but look at what is happening here with the hammer. After the hammer formation, there was a bullish move right there. After this hammer formation, that was a bullish move right there. So these are candles you should be looking forward to enter, especially the hammer. The hammer is very, very much accurate a lot of times. It makes your works easier and reduces your risk. Yeah, makes your work easier and reduces your risk. These are candles you should be looking out for. So that bearish hammer right there, you can trade with it on the EMA when you're looking for a downtrend. If you're looking for a buy trend, you should use the bullish hammer for it. Those are the things I use for my entries. Those are what I use for my entries. So if you understand the candlestick analysis, candles you need on the higher time frame, let me explain this. If I was to trade the market on this day after the formation of this candle right there, after the formation of this bearish candle, this is an entry candle, right? What will I be looking out for? I said trade on the 15 minutes or the 5 minutes. Let me start with the 5 minutes 5 minutes time frame. Now this is crash 500. I don't advise you to trade on 5 minutes because of how long and how huge the candle is for your risk management. You know, risk management is trading. When we get to risk management, you understand a lot of this. Now let me use the fatality 75. Let's go to the daily time frame. Now the market is trending above. You can see that what I said last time, this was a retracement for that day. Then the next day market started running bullish. Now if you have identified that this candle has been formed, now this is another day. This other one is a candle for another day. If you want to trade the EMA entry, if I go down to the 5 minutes, this is how I'll be taking my entries. I'll be waiting for a crossover of a beautiful candle. Look at what happened here. The whole of this stuff happening right here. This candle here doesn't have huge momentum, but even if you enter there, it is still good. It is still good to trade other one. But if you look at this is a beautiful one. this candle movement had a better momentum for you to enter right there, placing your stop loss right below that point. You can see what has been happening. There have been a bullish run all this while. Bullish run, because on the higher time frame of the one daily time frame, there have been a bullish move. So just wait for market to cross over the EMA, just like what happened here right there. Then that is when you start taking a buy. Then when it comes to risk management, I will tell you how to manage your risk in the aspect of trailing your stop loss, and we have to place your stop loss as well, so you know what you're doing in the market. And some trade you should avoid, even if all the conditions are met. Trade you need to stay off the market from. There are some trade you don't need to trade, just leave the market because of your risk management. So I wouldn't advise you to trade the market at this zone, because it has gotten to the EMA. This is where I leave the market to do its work, and later I can come back and see the candle formation, then for me to continue trading. But let me explain with this. Now, if I want to trade the retracement of these candles, when I see this formation right there, let me use the tool to explain this more better. Now, when we see this on the after the candle formation of this, after the bullish hammer, they want to trade the next day, because this is a bullish move for the other day. Then the next day want to trade this. Now, if you go down to the 5 minutes, what will you be looking for? You'll be looking for a crossover of the EMA. It's just the same thing. But this, look at here, look at what happened here. This candle is a kind of huge. If I was trading this on the 1 hour time frame, but if you want to trade it, you can trade it with taking, depending on your risk appetite. But that candle is very huge right there. So if I was trading it, I might enter the market from there, or I let it go, or return back to the 50% of this. 50% of this. When the market, when I see that the market has returned to 50% of, if you divide the candle into two, you can get a 50% split right there. So when the market gets retraced back to this level, you can take entry and place your stop loss below here. Then you buy all the way up, because that is a bullish move. That is a bullish move for that. Now the next day, I wouldn't want to trade this candle. I wouldn't want to try. Just stay off the market. Even if there is bullish move right there, just stay off the market. Now let's go down to, or let me still explain this as well. So you see this below the EMA, this bearish candle, that is the hammer below the EMA. Now the next day you want to sell, right? Then you wait for a crossover. And by the way, this will not be happening all the time. This will not be happening all the time. You will wait. So like I said, there are some markets you need to avoid when I come to explaining the risk management and some other stuffs. The time strategy, which is very important. The time strategy is very, very important. There is no way you trade this strategy without a time strategy. You will be having a lot of losses if you don't understand the time. Time strategy is very, very important on this strategy. It helps you avoid some trade, helps you manage your risk as well. So thanks for watching. This is Trade 8. I'll be dropping more of the videos. I think our next topic will be on time strategy or the flow of the market. These are the two things you need to know. So thanks for watching. Subscribe for more of this video.